The average rate on the popular 30-year fixed mortgage dropped 22 basis points to 5.99%. It hasn't been that low since the start of February 2023, and that's according to Mortgage News Daily. This came after President Trump posted on social media Thursday that he is instructing mortgage giants Fannie Mae and Freddie Mac to buy $200 billion in mortgage-backed bonds, or so-called MBS. He said this will drive mortgage rates down, monthly payments down, and make the cost of owning a home more affordable. And clearly it did just that on the news. But what does it actually mean going forward if Fannie and Freddie do buy more MBS? Well, so Fannie and Freddie, which are in government conservatorship, they don't originate loans. They buy loans from lenders, bundle them into MBS, and sell them to investors. And that helps replenish lender funds for new loans and keeps interest rates lower and more stable for home buyers. Purchasing more mortgage-backed bonds or securities does move mortgage rates lower. The Federal Reserve did it in the first years of COVID, a lot more in fact, and mortgage rates dropped to record lows. Now, while it is still not known how quickly this would start now and how long it would take, analysts are predicting where mortgage rates could end up. Most put the drop somewhere between 25 and 50 basis points, but some even lower. Analysts at UBS said this decline may provide a boost to both new construction demand and existing home turnover. So what does that mean to you and me? Well, a drop of 1/4 percentage point, say 6.15% to 5.9%, would save you on your monthly payment. How much? Well, for someone buying the median priced home, which is right around $425,000, using a 30-year fixed mortgage with a 20% down payment, the monthly payment would then drop by $118. Now, for some, that might not seem like a lot, but for first-time buyers right on the edge of affordability, it could make a difference. They would still, however, need to save for the down payment, which is currently the biggest hurdle for most first-timers who are already pretty stretched due to inflation. And then you still have to qualify for the mortgage with your credit rating and your income. Noted housing analyst Ivy Zellman points out that this is not enough to really get the market going because we know people can't qualify even at 4.99%. She said, "I think there's more work to be done." Now, if you're thinking of a new construction home, builders have already been buying down mortgage rates into the 5% range. But Zellman notes that this could still bring out more buyers to new homes who might not have known about that. But what about high home prices? They have been easing up lately, but lower mortgage rates generally boost prices. If you have a lower rate, you can afford more homes, so you buy more home. That's why prices shot up nearly 50% since the start of COVID, because rates sat at record lows for more than 2 years. Bottom line, lower rates will help some with affordability, but the housing market still needs prices to ease more, and it just needs more homes in general.